Hello, and welcome to KGI Advisors podcast series, the Business Restructuring Playbook. Today's topic, how to raise capital for tough deals. My name is Steve Green. I am president of KGI Advisors, a financial restructuring and turnaround professional firm headquartered in Los Angeles and serving clients throughout the United States, representing both companies and lenders. Our guest today is Jonathan Zucker, who is managing director and head of capital advisory group at Intrepid Investment Bankers. Intrepid is a subsidiary of MUFG, a top 10 global financial institution, and has approximately 100 investment bankers across the country. He and his team raise debt and equity capital for family-owned and PE-backed companies across various industries, and they are particularly well known for getting really tough deals done. Welcome, Jonathan.
Thank you, Steve. Great to be here.
So, the first question is, what's a tough deal? So I decided to look on AI and I said, hey, what is a tough deal? And it says a tough deal does not fit in the box. The numbers are messy, the timing is tight, and the story is complicated, but the business is still has real value to unlock. If it were easy, then they probably wouldn't hire you. So is there anything you would add in terms of what a tough deal is?
I think that's spot on. To me, a tough deal is one that has complexity, and that could be driven by internal factors or market forces. It could be a company that's up against the wall. It could be a situation in the industry, or it could be a severe time crunch. Frankly, in terms of what we do, I can't think of many deals that I would not call tough deals.
So I asked you before coming on the podcast to identify 5 areas you think our audience should be educated in and understand in order to get tough deals done. So let me review them with you. Number 1 is aligning expectation of ownership and management. Number 2, building an all-star team. Number 3, creating urgency in an organized manner. Number 4, explaining bad historical performance and or bad deeds. And the last one is finding the right capital provider. So what we're going to do is we're going to go one by one. You're going to sort of give an overview of your thoughts of each one, and then I'm going to ask you some questions. So let's start with aligning expectation of ownership and management. It's all yours, and then I'll ask you some questions.
I think of a company as a crew team in a boat where ownership and management are in the boat together. If any one element of that collective team is rowing in the wrong direction, the boat just goes in circles and never gets to the destination. That's what it's like to get a complex transaction done. We see situations where there's misalignment, whether it has to do with economic incentives or other factors that lead to problems in navigating a difficult capital raise. The best practices to solve misalignment between management and ownership include, number 1, just creating economic alignment. It's tough enough to get complex capital raise deals done, but when management and ownership are not aligned, it can become a disaster. They have to be aligned economically and they have to be aligned philosophically. And this could come into play when you're looking at different scenarios, whether it's an equity raise or a debt raise, what type of capital you're going to bring in, how it's structured, how such capital values the entity. And there could be situations where ownership is looking for the highest valuation or the highest leverage profile, but that could be to the detriment of management that's looking for an organization where they can have sustaining relationships with their customers and with the employees internally. So economic alignment is key among them. Number 2 is just misalignment on the vision of the business. And that's why it's really important to look at the model together and look at multi-scenario analyses and have management and ownership really sit down and collaborate and look at what's in the best interest of the company from a fiscal perspective, from a cultural perspective, and a philosophical perspective, because ultimately that's what's going to drive economic value for everyone. And 3, I think, it's important for both management and ownership to talk to their advisors together to get on the same page, because typically you're surrounding yourself with a great team of advisors, which I know we'll get to later. And if you can get on the same page where the professionals around the table can sort of explain what's in the best interest of each party, it can solve a lot of problems in the long run.
So let me ask a couple of questions. How do you facilitate tough conversations? Like there's going to be conflicts. What do you do as the investment banker to help that whole process?
I like to say that my job as an investment banker is 50% psychotherapist. And we're really in the business of having difficult conversations, whether that's with our clients, with other stakeholders, with the investors on the other side of the table. So I think first and foremost, you have to be comfortable as an advisor to a business, as management, and as ownership in having difficult conversations and getting to the truth, the unvarnished truth. So the way we approach conversations with management, with ownership in these transactions is to sit down and lay out the facts. We have years of experience and decades of experience doing deals, and we can explain, here is what happens when businesses that think the way you're thinking pursue the wrong type of transaction. So I think the way we approach it is we've got data, but we also have the human touch to understand how to have difficult conversations with the team.
Yeah, and I assume that getting this done before you go to market is important. Otherwise, you lose time or you lose on due diligence. Is that fair?
Absolutely. It's critical to be organized and be aligned between ownership and management before going to market, because frankly, the process of doing a capital raise transaction, it's a whole second job for management, and it's a whole huge psychological or emotional distraction for ownership often. So if you're going to require that everyone get on the same page, because you're going to have to work with your bankers and your financial advisors and other consultants to get the numbers together, to get the book together, the story together, and figure out the game plan of how you're going to go to market and who you're going to approach, you really need to get on the same page, because this process of raising capital is very intense and intensive, and it can last weeks or months or beyond. And if everybody is misaligned at the start, you're just setting yourself up for disaster.
Bottom line is you got to get alignment to get a deal done. That's great. All right, the next topic is building an all-star team. Talk to us about it. Why is it important? And how does it help get a deal done?
We just came out of an epic World Series here in Los Angeles, and we saw what the Dodgers were able to accomplish. And while they have a bunch of former and future MVPs on their team and Hall of Famers, I would argue the reason the Dodgers actually prevailed in the World Series is because you had guys like Miguel Rojas in the ninth position hit a key home run. You had them put Andy Pajes into center field to make the game-winning catch in the ninth inning. And so it really, to win and to win on the field or to win in a capital raise transaction, you really have to stack your team from top to bottom, because you don't know who's going to get the key at bat or where the ball's going to get hit, to use a sports analogy, and investment bankers love to use sports analogies. So when I think about that in the context of a team to get through a capital raise, that involves both the team within the company and the team the company surrounds themselves with of key advisors. We spend a lot of time as the investment banker to our clients helping to play the executive producer role and meticulously arrange around the table advisors that can really help the company to get from point A, which is thinking about a transaction, to point B, which is launching into the market to pursue a transaction, all the way to point Z, which is a successfully closed transaction.
A couple of questions. One is, if you don't have this all-star team, how does that show up once a deal starts developing?
If you don't have an all-star team, there are various places where the whole situation just breaks down. And for starters, when I think about the process to raise capital, I'll think about the getting ready to go to market, the going to market, and the completing of the transaction. And just in the getting ready stage, it is imperative to get your facts together, to get the data together, and then to get the story together that you're going to package to investors, whether it's a debt deal or an equity deal. And so that's where having advisors like your investment banker who's going to craft the story and the book, like potentially an accounting firm who's going to do a sell-side quality of earnings report, even for a financing transaction, to validate the numbers that you're presenting in the materials, and potentially having someone like a financial advisor who's coming in and making sure they can go back at your historical numbers and make sure they foot and tie to the projections that are moving forward. Having all those pieces in place are key to building credibility. So when you come out of the gates with that story you're packaging to investors, it holds up. So it's extremely important in the preparation phase to have the right people around the table so you get the right product into market. And then once you're into market and pursuing a transaction, it's critical to have the right team around you to make sure you're running the proper process to solicit investors, the proper process once you have a deal on the hook and you're coordinating with counsel to document the deal, and so on and so forth. And there are just various places where things can go wrong. And just as a key example, we have a lot of clients that might say, well, My brother-in-law is an attorney. He helps do our real estate deals and our tax work. He can be the deal attorney on the deal. We've seen these things go terribly wrong to where not having a great deal attorney can maybe make a deal never happen to begin with because it just drags out and time kills all deals, or the deal happens and you're not adequately protected because you did not have someone in the trenches who knew how to properly negotiate a credit agreement or a purchase agreement.
I could hear some people saying, how do you justify the costs? You know, this all-star team costs a lot of money. So how do you justify it, or how do you manage it also?
So I graduated from the University of Pennsylvania, which was founded by Benjamin Franklin. And Ben Franklin said, an ounce of prevention is worth a pound of cure. And I love that aphorism among his many others. And I think what we see a lot of times is clients who can tend to be penny wise and pound foolish. And we try to sit down, and often some of the other advisors we help bring around the table are really good at articulating this. But if you had a sell side quality of earnings firm and in conjunction with a financial advisory firm could find $1 million of earnings add backs in your trailing financials, and that translated to $10 million of enterprise value in your business, or the ability to raise $3 or $4 or $5 million more of debt in a debt transaction, would that be worth spending $30,000, $50,000, or $100,000? If you were offered an investment opportunity as that owner or management team to invest $100,000 to make $5 million, you would do it all day long. And that's how I think about the expense of hiring the right attorney, the right CPA firm, et cetera, to get a deal done. These things are the best investment you can ever make, like a venture investment where you're in a Series A and the company goes to IPO.
And I was thinking it also helps timing. I mean, a great team will get deals done faster. Fair?
Absolutely. Assembling an all-star team makes deals happen faster. It helps you more efficiently prepare to go to market, and then it helps you to get out to market, and then it helps you once you get someone on the hook and you have to go through, call it the confirmatory diligence phase, that you can check all the boxes quickly. And again, there is, in almost every situation in complex, tough deals, there is time urgency. And so having that all-star team, it pays for itself. And there is not just the economic cost of doing a deal versus not doing a deal, but there's the opportunity cost of dragging out a deal and the time it takes, taking management's eye off the ball and running the business.
Let's move on to the third one, which is creating urgency in an organized manner. So talk to us why this is important.
The investors we go to in a transaction, whether they're lenders in a tricky debt refinance or equity investors in a growth raise, they're all human beings, and there tend to be type A personalities that love to compete and hate to lose. And so one of the things we like in a process is we create urgency, we put everybody on the same track, and they know they're competing to win the opportunity to be that lender or investor into a deal. And so creating urgency around the situation and getting those competitive juices flowing, that's how we can drive real interest. And we like to say, maximize the outcome, whether it's the lowest interest rate on a debt deal, whether it's the highest valuation on an equity deal. So once we go to market, we really try to create urgency to keep everyone on a tight timeline. At the same time, when a business is in a complex situation, whether in the industry or internally at the company, time is usually not your friend. It's very rare that the deeper we go into a process for a tricky financing, particularly in something like a tough refinancing, that things are getting better at the company if we drag a process out from 2 months to 6 months. So it behooves everyone in the organization, from management and ownership, to create this urgency once we're going out for the capital, but also in the process of getting ready to go to market. Again, this is a whole secondary job for management. And so we have to create urgency, but make it very organized because we don't want to fatigue people. So as the investment banker, when we work with clients, we organize around a very specific deal calendar, and we sit down with the key members of management and understand, okay, what are the obligations you have over the next 3-4 months while we're trying to get this transaction done? We're going to overlay that with holidays, and we're going to overlay that with where we know the busy time is for the investors we're going out to. And then once we get an investor on the hook, we're going to work on a very tightly managed exclusivity timeline with that investor, where they know if they drag things out and we're giving them everything they want, they can get kicked out of the process. So it just keeps everybody to task and minimizes the idea that the deal could fall out.
Great. So what are some of the things that prevent urgency from actually happening? Like, what are the obstacles?
First and foremost, if the company is not ready for prime time, it's hard to suddenly flip a switch and say, hey, we have to go raise $50 million of capital, but our financial house is not in order. We don't have a competent CFO or a controller at the helm. We don't have a counsel ready to go to help us not only negotiate the definitive docs later, but help us negotiate the initial term sheet when we're getting into a deal. So I think having the ducks in a row is important. And if a team doesn't have sort of its act together and suddenly they're impressed with a sense of urgency because their bank is looking to kick them out, or they have an acquisition they want to accomplish, but it has to be done in 90 days. If they haven't spent the last several months or years getting their house in order, then it's hard to flip a switch and get a quick deal done.
Is there a way to turn urgency into an advantage to close a tough deal?
There's absolutely a way to turn urgency into advantage to close a tough deal. I can think of an example. We had a client, it was an audio electronics business, and they desperately needed financing because they had a big new product launch that they were going to be announcing at their big industry conference. And they needed to make a big purchase ahead of the announcement because the expectation was once the announcement was going to happen, all the retailers were going to make huge orders. While we were in the process of raising capital, the company was starting to crack internally. But if they could hold it together through the process, they were going to be able to secure the capital before sort of all the warts got exposed to the other side. And I think it was critical to use the urgency of this industry conference and the product launch to the lenders that were in the process to say, you're either in or out of this deal and you have to tell us in the next X number of days, because if you can't close on this timeline, then your financing's no good anymore because we've missed the window.
Okay, let's go on to the next one. So most tough deals have to explain history in some way because either bad history performance, maybe bad deeds. So the topic is explaining bad historical performance or bad deeds. How do you tell us about that and why it's important?
The idea of explaining away historical bad performance or bad deeds is a tricky one to navigate. There's a lot of sensitivity, and part of it starts with having a real open, direct relationship with your client. So as the investment banker, or if you're the counsel or other trusted advisor to the client, it's important first and foremost for the client to come clean to those on his or her all-star team about what happened. Both here are our financials, not just going back 2 to 3 years, but over the last decade or beyond. Here is where the skeletons in the closet lie. We had some lawsuits or employee issues or other things. First and foremost, the company has to come clean to its advisors, so we as advisors know how to effectively package and position such past bad deeds or underperformance to the market. Because rest assured, there's no hiding skeletons in the closet anymore. If there was bad performance in the business, or if there was a lawsuit or another bad deed, that investor will find out. It's just too open a world out there. So rather than say, how are we going to best hide the bad deed? It's more of, let's get in front of it. Let's find out what it was, and then let's work with our advisors to create the analyses and the positioning and the explanation so that when the investors do find out, and hopefully from us proactively sharing with them, they can say, okay, we understand what happened. We respect the company for being forthright about this, and we can see based on all these analyses they've presented why we don't expect this to happen during our period as their investment partner.
So how important is data and forecasting and digging deep into using that to explain the history and also to help the credibility of the future forecast?
Data is hugely important in terms of building credibility, both to explain the history and to show a credible forecast to the investor. Look, we as investment bankers, a big part of our job is storytelling. So we love putting a great sheen and positioning the company and its management and the products or services it provides as game-changing, industry-leading, and all those great buzzwords. We love the story. But at the end of the day, the numbers don't lie and data doesn't lie. And we have data-obsessed investors on the other side of their transactions. So it is critically important to get our arms around the data, to understand it, and position it appropriately. And if we're building a financial forecast and none of the metrics look remotely similar to what's in the historical numbers, we are going to get called out on that. And either that forecast is inaccurate, or if it could be credible, it's because we can very clearly explain through contracts or different business practices or an improvement of the organization why those are credible. So data is hugely important, and it goes beyond revenue metrics, but really digging into customer level unit economics, historical performance versus different kinds of economic backdrops, different history of the customer concentration within the business, and then looking at how the business rebounded from bad deeds or past underperformance.
Yeah, so when we're helping companies, what we say is we want to get the answers before they ask the questions. So we want to be in a position where we're going to not only disclose something, but we already have the data and the analysis ready to explain it, so they don't have to spend a long time trying to figure it out. And I think that helps with credibility. Fair?
Absolutely. I love that. Have the answers before the questions are asked. And I think in many cases, we're actually sharing the answers because we try to anticipate the questions. And when we as the investment banker put together the book to market a capital raise opportunity, I always sit down with my team when we're drafting and I say, think of the top 10 questions they're going to ask after they read the book and answer them in the book so then they don't ask those questions.
Let's move on to the last one, which in many ways, I think most companies that are looking for capital, that's their first question is, can you find the right provider? Finding the right provider. How do you go about doing it? And how does it work?
Finding the right capital provider is the key to unlocking this entire capital raise exercise. And I really think I missed my calling. And I feel like when I go and watch the old play Fiddler on the Roof and I think about the matchmaker, that's probably what I should have been for a living, because at the end of the day, it's kind of what I do. The investment bankers and the processes we're running very, very high stakes matchmaking processes. So what does that mean? Well, if you're a matchmaker, on the one side, you need to know your client intimately. You need to know everything about them so you can properly position them to a potential mate. And on the other side, you need to have the absolute best database of potential mates or dance partners for your client so you can make that perfect match. So when I think about the value an investment banker would provide, for example, in this situation is we are covering hundreds and hundreds and hundreds of different capital providers, and we know them at such a deep level, not at a surface level of what their website says or what their one-pager says, but having completed deals with folks or seeing how they act in processes or having them be a part of other client transactions and seeing what happens down the line when there's a bump in the road. So we have so much data, to going back to your point on data, on the investment partners or the potential partners for our clients. And we have hard number data, and then we have sort of the intangible understanding of how do these partners behave and who will be a good fit with the client, both from a sort of chemistry perspective, from an industry perspective, and a situational perspective. So if we have a client that's looking to be an innovative company and they're looking for high octane equity growth capital, we're not going to go to a distressed debt fund for that capital. But take a step further, we may go to dozens of different high growth equity investors for the same deal, but we can read and we get 3 different term sheets on a transaction and they all look substantially similar on paper, but we know behind all of those, who are the partners involved, what is their value add to the business, et cetera. So I think finding the right capital partner is a high stakes matchmaking process that involves knowing the client extremely well so you can position it properly, and then knowing the universe of capital providers at an insanely high level.
And how do you know whether to go after debt, equity, or some hybrid? How do you figure that out?
So we work on capital raises across debt, equity, hybrid, structured capital. And in many situations, we know exactly what we're going for on the front end. We may know that something clear as day is a debt refinancing or a debt dividend recap transaction because the business has certain metrics. They can certainly qualify, they can service debt, and the ownership has made it clear that their particular goals in a transaction are non-dilutive capital or debt financing. So there are those situations when it's clear as day. And on the other hand, there are companies that are coming in and saying, they are either extremely debt adverse or there are businesses whose balance sheets and cash flow does not support a debt transaction, and or they may not have asset coverage. So we know they need equity capital. They need somebody that's underwriting the future of the business because there are no hard assets, there's not a lot of historical EBITDA, and there's not an ability to service debt in the real term, but there is significant value to unlock for the equity. So there are those situations where it's clear as day going in, it's a debt deal, it's an equity deal, it's a combination. What's great, though, about these processes to raise capital is there are other situations where we do not need to know on the outset what kind of capital, and a business may be going to the market to explore alternatives to either refinance a lender, raise growth capital, to make an acquisition, or buy out a shareholder. And we may be able to go and package an opportunity and call on various debt sources, various pure equity sources, and this growing realm of, I'll call the in-betweens, or we'll call it structured capital or hybrid providers. And many of these, by the way, are the same funds. There are private credit funds that have an equity arm and then they have a mezzanine arm. And there are private equity firms that have a structured capital arm and then do a senior debt arm. So interestingly enough, in probably 2/3 of the transactions, we know we're going out specifically for debt or equity. It's very self-evident. And the other third, we are going out for a range of strategic alternatives that may involve one or the other or both.
Yeah, let me ask you kind of a softball question. How much value is it to have Intrepid's name, or quite frankly, any credible investment banker going to market when you're going with a tough deal?
That's a great question, Steve. And I can say, as somebody who has worked at larger investment banks and then a serious middle market firm like Intrepid, but also much smaller boutique firms, it can make a huge difference. Having the stamp of credibility, one, having an investment banker who's got some level and some modicum of credibility is table stakes, I think, to attract a certain level of capital providers, because it shows an advisory firm that's credible, that's in the market, is willing to allocate resources and the opportunity cost of their time to work on your transaction. So I would say having an investment bank out of the gates is a good table stakes to work on a capital raise transaction. And then to take it a step further, having a firm like Intrepid or another notable middle market firm that's got name recognition across private credit, across private equity, mezzanine funds, and other types of investments, it is huge, because these counterparties on the other end, whether they're lenders, equity folks, or hybrids, they get inundated with deal flow from companies directly, from brokers, from no-name investment bankers. So getting a message, whether it's a phone call, an email, or some other outreach from someone you either know very well, or if you don't know the individual, of course, you know the firm. Oh, I've heard of that firm. They have a national footprint. They have over 100 investment bankers. They've done deals in sectors in which we like to invest. Of course, I'm going to take this call. So I would say I cannot overestimate the value of having a firm like Intrepid on the book when you go to market.
Is there anything you want to add before we come to a close?
Thanks for having me, Steve. It's been great. I would just say I can't overestimate enough the importance of an all-star team in coming together and then unlocking the whole capital raise process, which, like you said in the last of my 5 points, is finding the right capital provider. So it takes a lot of steps. It takes a lot of sweat. But if it's done properly, it can be done incredibly efficiently and as painlessly as possible. So I think working with folks like Intrepid and KGI and others around the table, we've thankfully got a lot of references out there to sort of indicate how notable and helpful that was in completing a transaction.
Great. Thank you, Jonathan. And if anyone wants to contact Jonathan to ask more questions, you're welcome to do so. The contact information is there. Please follow us. We're on YouTube and Spotify and other platforms. You're welcome to watch us. We have a number of podcasts that are out there, all dealing with the business restructuring playbook. Thank you very much. Good day.